Here's a market update for August 14th, 2023. Has the soft landing arrived for the US economy? Reminder, this is not financial advice and do your own research. So we've been hearing the term soft landing in the mainstream financial news for about 6 months now. In the beginning, it was just a question of if it was even possible, and now the voices are getting much stronger, and you see the mainstream fund managers and analysts talking about a soft landing. So I thought we could define this a little bit. I think it is important as a term, and we'll talk about why does it matter. So by soft landing, they're referring to Jerome Powell and the Fed and their actions regarding Fed rate policy and whether they can manage sort of a Goldilocks balance between rates that are tight enough to keep inflation down and yet loose enough to keep the job market and economy going strong. So the Fed mandate is keeping inflation low and jobs up, and soft landing is finding this balance quite between the two. Now, why does this matter? Of course, a soft landing implies that they have this Goldilocks scenario where they've got everything just right. And you have, therefore, a more stable economy with companies earning, jobs being created, and low inflation around 2 to 3%. And this is supportive of asset prices, including stocks, crypto, and everything else. And so I think it's a very useful to kind of analyze what is meant by this in more detail, and then see if this helps us make some very modest predictions about the future. Before we go deeper into our content on the soft landing thesis, let's just quickly look at the S&P 500 chart to get everyone up to speed. You can see the blue line at the bottom is the 200-week moving average. You can see at the end of 2021, we had the peak of the S&P 500 at 4,800. That was an all-time high. It then fell over the next 10 months in 2022, and it bottomed in October of 2022 at 3,500. At that point, most of the market was bearish. You had about 80% of analysts saying we're going lower. We're going to have a major recession because of the inverted yield curve and the historically rapid rate hikes. So we were going to go down to 3,000. We were going to have a major recession. Corporate earnings were going to fall off the cliff. Real estate was going to go way down as mortgage rates rose, etc. None of this came true. The bears were wrong. They were short and they've been squeezed, so the market's gone higher. January to March, we had sort of a grinding higher highs, higher lows, and then we've taken off almost parabolic here. Parabolically, we went up to 4,600 recently. We've now pulled back a little bit, but we're holding at 4,500. So the bulls were right, the contrarians were right again, and a lot of people have lost a lot of money in shorts. Notably, retail turned bullish, and now the institutions are catching up. They're maybe halfway, setting their S&P targets higher to maybe 4,200 instead of 3,000 by the end of the year. And so if we do have a soft landing materialize, I think it's very supportive of the market. You'll definitely see the 200-week moving average holding, and we'll probably have new all-time highs by the end of the year or early of 2024, maybe in the range of 5,000 on the S&P. So let's go deeper here and try to define what are the conditions for a US soft landing, what is meant by this, and what are the metrics for defining whether this has already occurred or whether it will occur. Okay, so number one on our list here is that inflation stays low. We'll look at the inflation chart in a little bit, but basically that's key. It's critical because a lower inflation rate means the Fed can ease its rate policy, okay, and makes financial conditions easier, and this is supportive of asset prices. So if inflation can stay low, it means the Fed can stop raising rates, and the Fed can cut rates if we have any weakness in the economy or job losses. Number 3 is corporate earnings stay strong. This is necessary. We've had better than expected corporate earnings in Q1 and Q2 of this year. Again, the bears said that this would fall drastically. Expectations were revised lower, but then those were beaten. So corporate earnings are managing to stay strong. This, of course, supports the job market and asset prices. Number 4, we need to see the entire U.S. economy keep growing and be healthy. And then number 5, we need to see U.S. consumers spending continuing. So the U.S. consumer is 70% of the U.S. economy and corporate profits, and we need to see them keep spending. A subset of that is we need everyone to have jobs, so the job market needs to be strong. Real estate prices need to hold up because that causes a wealth effect. You know, if your house is going up, you feel better and you spend, whereas if your house price is falling, you start to panic and pull back on your spending. And then finally, credit conditions. People need to be able to borrow money. Rates are higher, so the new mortgages are expensive, but we need, people need to be able to borrow, and credit lending needs to be reasonable. My main message in this video is that current data does not support a recession thesis. That said, we do try to forecast the future and not the present. So Fed monetary policy has time lags, and we could be seeing the impacts of this tightening very soon. Tighter credit could weaken the U.S. consumer spending. Inflation could re-accelerate. Data like an inverted yield curve has historically preceded recessions. So our first point on having a soft landing is lower inflation. On Thursday, we just got the CPI update for July. So we see that July U.S. headline inflation is up slightly to 3.2%, but you can see we've fallen drastically and the trend is down more towards 2 in the near future. So I'm not concerned by the slight tick up from 3% to 3.2%. July core CPI also fell down to 4.7 from 4.8. Core CPI is watched more closely by the Fed, so this is more important. And on a 3-month trend downwards, we're falling drastically back towards 2 to 3%. Perhaps by early or mid 2024, we could hit a 2% handle on core CPI. This chart looks at core CPI historically back to 2000. You can see we are falling quite quickly from looks like about almost 7% down to 4.7. Again, on a 3-month window, annualized, it's falling extremely fast, and things are looking pretty good here. A large percentage of the existing inflation has to do with shelter. Shelter lags quite significantly in terms of either rising or falling trends. So basically, as the rent agreements renew, right, they tend to be locked. You'll have a 1 or 2 year lease. And so it takes time for most of these leases to turn over to new lower rental agreements. And so the Fed had only started raising rates about a year ago. Something like a 2-year lease wouldn't have come up due yet to be renewed at a lower price. So that's why a lot of the analysts are confident that inflation's going lower towards 2 to 3% because of this time lag, and these longer leases should be resetting in early 2024. Our second point is that the Fed stops raising rates if we want to see a soft landing. So you can see the chart has gone from 0% in early 2022 all the way up to 5.5%. It's a very drastic and very quick rate hike cycle, and it needs to stop basically. I think it has. We're at 5.5%. We might get another 0.25 in Q4 of this year. But I think that's it. I think the Fed needs to stop raising rates, and I would argue it can't raise rates much higher for a few reasons we'll go into. But of course, once the Fed stops raising rates, the market starts to price that in, and that's why we've seen asset prices become more bullish. So here's an argument for why the Fed won't raise rates much higher, and maybe more importantly, why it can't raise rates much higher. So I'll argue both here. So number one, they've already met their mandate. Inflation has fallen from 9.1% to below 3%, and jobs are strong. So they're kind of in this sweet spot. Jerome Powell might have actually pulled this off. And so there's not much will or desire to raise rates. Number two, they don't want to cause a major economic catastrophe. They did have a couple banks get in trouble and go bankrupt and have to close. So bank failures. Jerome Powell does not want to break anything. And now that inflation is down, I think he'll feel more relaxed to keep rates where they are or to even cut them if necessary. Number four, 2024 is a U.S. election year, and the Fed is a quasi-political organization. By this, I mean it is appointed by Congress, I believe, and they serve the U.S. economy and the U.S. people, right? That's why they created it. So raising rates in an election year and then risking a crash of the economy in the middle of the year would be bad for Joe Biden and the Democrats. And I don't think Jerome Powell wants to be accused of, causing one party to lose the election. Point number 5 is that U.S. government interest payments are spiking. You can see the chart at the far right. It's rising exponentially there. The issue is that as they've raised their rates to 5.5%, they need to make payments at 5.5% to bondholders. And this is causing a great expense within the fiscal budget, and it's not sustainable. This is what I mean by they can't raise rates. So they may have an interest to raise rates to fight inflation above 5.5% to 6%, but they can't make these payments on a long-term basis. And so we're not hearing enough of this in the mainstream news, that it's actually that they have limits on how high they can go. Point number 6. Exchange rate differentials. So it's notable that Japan has not raised its rates because they can't, and Europe has not raised their rates as much. So if the US was to continue raising rates, you would see renewed US dollar strength and some stress on the US JPY or US Euro exchange rates. And I don't think that's what people want. So again, global debt to GDP is horribly high all over the world. And it's very dangerous territory to get above 6%, in my humble opinion. And so I don't think they can raise rates even if they wanted to. The sigh of relief for Jerome Powell is that he probably won't have to, because it seems like inflation is falling either on its own. Maybe it was supply chain issues from COVID, and then also because of the rate hikes having some impact. Point number 3, that's a requirement for the soft landing narrative to be realized, is that corporate earnings stay strong. You can see this chart is from Q1 of 2012 up into Q1 of 2023, so about 11 years of data. And you can see corporate earnings are very strong, above historical average, and it fell a little bit, but it looks like Q2 was probably the bottom and will get stronger again. Especially with no recession. Companies are revising estimates upwards, and companies are making money. And that's again why we've seen this bull recovery since January. Another encouraging chart here. This is point number 4, U.S. quarterly GDP growth. Except for the COVID crash in 2020 that you see, I don't know about you, but I see a very strong trend that the U.S. economy is growing, GDP is increasing, and Q1 of 2023 was good. We've now seen a 2.4%. I believe that was Q1 or Q2. Must be Q1. Q1 had a 2.4% increase in GDP. This is not extremely high rate of growth, but it means that the economy is growing. There's jobs, people are making money, and you have a good circulation of currency and profits. And so all good here. And our fifth point regarding a soft landing is that the US consumer keeps spending. The US consumer is 70% of the US entire economy. It obviously is why companies make profits and hire people, and it's essential to the entire machine working. You can see this is the quarterly, and July 2023 is an all-time high on this chart. People are spending money. The Bears said that the consumer was going to run out of money in early 2023, and we're having a big recession, and they were wrong again. And so we're seeing spending continuing. There's a lot of reasons for this. I'll go a bit more deep into this, but just needless to say, this is essentially it's essential and needs to be watched very closely. This chart shows consumer confidence levels being above average and positive, supporting a thesis that consumers haven't lost faith yet. So why is the US consumer spending? Okay, well, there's lots of jobs. The jobs market is strong. Unemployment rate is down to 3.5%. Real estate prices have held up, which creates a wealth effect, so that when your house goes up in value, or at least it doesn't fall, you feel better about your personal house finances and you're more willing to spend. Credit conditions have tightened, but it's not affecting everyone. You have a huge boomer generation with tons of money. A lot of them have their houses paid off and they're spending, right? We have airlines busy, cruise ships are busy, hotels and restaurants are busy, lots of travel. So we're seeing a rebound from the COVID period where people had saved up money, they're spending, and the spending is continuing. My note here on real estate prices, they've been rising since January of this year. So the big bear argument was that the higher rates from the Fed would trigger mortgage rates to rise, which they have, but the bears were arguing this would cause a crash in real estate prices. They've been wrong. Prices are rising again. So this has confused a lot of analysts, again, that were wrong about prices falling. And the reason for this, it seems to be that it turns out that 42% of US homes have zero mortgage. So these are boomers that have paid off their houses and they don't care about higher mortgage rates because they don't have a mortgage. For those people that do have a mortgage, 65% of them have locked in a mortgage at a rate below 4%. So we had very low rates for many years where people were getting mortgages at 2 or 3%. They're locked in. Once again, unless for some reason they have to refinance, they're not affected by these higher rates. So actually the supply of houses on the market is very low because people are not wanting to sell and have to refinance. And this is the low supply is causing prices to rise, again, creating this wealth effect. This chart is showing housing supply being very low for the reasons I just mentioned. People are not wanting to sell because they don't want to refinance. And yet you do have demand. You have millennials that want houses. You have immigrants moving into the country. You have population growing. And so the supply is low and the demand is marginally higher. And so prices are rising. This is median house prices, and if you look at the very far right, top right corner, you can see it fell slightly and then bounced back up. You can see prices are well above even as recently as 2021 and all times previous. So a lot of people have equity in their homes. They do see prices at least not falling and in many cases rising. They feel good about that, and so they take that extra holiday or buy that extra car. One thing I'm not hearing a lot of in the mainstream news is fiscal spending in the US. So we hear a lot about monetary tightening from the Fed, raising rates to 5.5%. But what about government spending? And it does seem to me that the government spending is perhaps overwhelming or at least mitigating the tightening on the other side from the Fed. So you can see this chart, we have the historical federal spending, and that it has fallen slightly in the last year or so. However, it's still historically very high. You can see spending at the top right versus revenue. So the government, the U.S. government is running a deficit, and this money is going into the economy. The Biden White House signed a $1 trillion infrastructure bill at the end of 2021. However, this is just starting to be spent now, and the money is just now starting to go into the economy. As mentioned, 2024 is an election year. There will likely be additional spending both at the state level and at the federal level. And so the government's not stopping spending and has the ability to override tighter Fed policy. In fact, the Fed is a subset of the White House, in my opinion, even though they say they're separate. They are appointed by Congress, and ultimately they serve the interests of the American people. Looking at the bear side of the argument with risks to the soft landing thesis, yeah, of course, there are always risks. Recession, the bears will say this is coming once the 5.5% Fed rate finally impacts borrowing and housing prices. So they're saying there's a lag, and that the rate hikes will start to bite into the economy and cause a cascade of problems. Another argument, number two, is that inflation will start rising again because of perhaps energy prices and cause the Fed to raise rates maybe to 6% or higher, and this would just wipe out borrowing. The theory is that one link in the chain breaks. For example, companies' profits go down, so they stop hiring, and people start defaulting on their housing, and then the housing market crashes. So sort of a snowball effect. A third bearish point to watch for is more to do with asset prices than the economy, but simply with stocks. If everyone turns bullish, we get a melt up, but then a huge crash. Similar to October of 2022, where everyone was bearish and then the market turned bullish, we could have the case that everyone becomes bullish and then the market goes the other way. So this is definitely something to watch for. In terms of being a contrarian is always a good perspective to start with. And I agree that if we get to new all-time highs in the S&P, you could have just the entire market bullish, and this would be dangerous. If stocks then crashed, it could affect the real economy in a negative way, causing a negative wealth effect. Okay, so concluding up with the video, I'll reiterate that the current data does not support a recession. Corporate earnings have held up, the job market is good, real estate prices have held and are even rising, and consumer spending is reasonably strong. A soft landing means the US economy keeps growing, and this is supportive of asset prices. And as we speak, this is what's happening. Now, we do need to watch for lag effects from a tighter monetary policy damaging consumer spending. I think that would be the big one for me, is the credit issue. As mentioned, 70% of the US economy is consumer spending and is very sensitive. So while the job market is doing fairly well, you could see the credit tightening situation being the trigger for a cascading negative sort of snowball effect and throwing the US economy into recession that would definitely bring down stock prices and things like crypto. So back to our S&P chart. Yes, a soft landing seems to be in play. We could hit that 5,000 S&P all-time high by the end of the year. If it turns out at that point that the data is still supportive of a more robust economy, that could hold and could push higher into a new bull run. However, if we're sort of in a middle way there where the economy's not that strong and we've hit all-time highs, you definitely want to be careful there. As mentioned, if everyone gets bullish and it's not justified, we likely have a crash at that point. Generally speaking, the next 12 months, I think you need to take it month by month. It is notable that 80% of analysts were wrong, and it's always good to be on the contrarian side of things. Important reminder is that asset prices are not the same thing as the economy. So you can have a weaker economy with higher asset prices, and vice versa. You can have an economy that's strengthening while asset prices remain low. So they tend to correlate, but it's not always the same thing, and you can have as much as 6 to 9 months gaps between the two. Thanks for listening. You can find me on Twitter at Gresham's Law 7.